What's going on, everybody? Welcome to Stock MVP. Today, I want to talk about Netflix. It's had a recent run recently, and is currently doing very well for investors who've just bought in, but investors who've been buying this company back since pre-pandemic, not so good. So let's have a little look and see my thoughts and my opinion on if Netflix is a buy at its current price. The revenue for Netflix is going up at a decent rate, which is decent to see, and you'd expect to see and expect this to continue. The net income, though, has been a great picture over the last 3 to 5 years, but recently not so great. Netflix has been losing subscribers. We know this. It's starting to fill that void. We need to find new ways of getting new revenue. Maybe the ads on the new features will help boost the net income. Let's see. The free cash flow, though, is absolutely staggering how well they've been doing, which is a great thing to see. The dilution is slowly slowing down. 3% in the last 5 years, or 0.47% extra shares outstanding in the last 12 months. Quick ratio of 4.89, which is great. Anything over 1 typically means good in terms of Wall Street. 4 is absolutely insanely good. They have a very good solvency. Moving over to the cash ratio, 6.5. Typically, 5 to 1 is pretty good on this, or 0.5 to 1 is pretty good. 65% of all of their debts can be covered by cash or short-term equivalents, which is great. Profit margin of 17.82. This is a tech company, but it is also a promotional operational company in terms of movies and development. So you can't expect tech profits of plus 30%. I think that's actually not too bad for something in the movie industry, to be honest. 35 PE ratio is not too great in this current market, let's be honest. And the free cash flow of 98 is insane. People are paying a premium for Netflix still. They, of course, don't pay you a dividend and so on and so forth. And if we look over the last year, they're not too bad. They're only down 7%. So it's not that bad. In the last 3 months, they're up 25 too. Overall, the stock is sort of in the middle range. What's happening with insiders? Now, if we look at the insider tab, we can see that there is a decent institutional ownership. 80% typically for me personally. I like anything over 80. So that's just right in my wheelhouse in terms of ownership. Vanguard owns 7.8, BlackRock 6%, FMR 4.5% there. And there's been a lot of insider acquisitions and buys. We'll come on to that in a second. The institutional ownership, sorry about that, I'm making you go dizzy here. Institutional ownership is doing quite well, 360 million shares there back in 2013. And now it is a little bit less, but not much. So that's a tick in the box for me. Now, all of these shares have been awards by the look of it, which basically means the insiders, so their co-CEO and chief content officer, they've been awarded shares. These are usually Christmas bonuses and so on and so forth. But I can't really see any buys, so nobody's actually dipping into their pocket. But yeah, there's been no sells as well, so that's a good thing. In terms of senator trading, there's been nothing really since March last year. So yeah, nothing really to report there. And if we look at the discounted cash flow tool, now Netflix's EBITDA has been going up quite decently. 5 year, it's up 200%. The last year, it's up 11. I'm obviously going to be conservative because we're in a market where layoffs are happening and who knows what's going to happen with the world. We've got a depreciation and amortization of 20% year on year, 60. So let's go about 20% there. The capital expenditure is a bit all over the place. I'm going to probably put a 5 year average of 20% here. So EBITDA growth, I'm going to put 15. Depreciation and amortization, I'm going to put 15. Capital expenditure, probably going to put, no, I'm going to put 20 and click populate. Long-term growth rate of 4. I think that's probably going to be dropping to a 3. And a discount rate, I'm going to put 15% because the market it's in, I need a little bit more safety net. I need a little bit more calculated in there. And if you put that in there, it basically says that it is undervalued by 70%. And that means it's also going to pay you a decent rate of return of potentially 15% if it gets priced correctly in 5 years. Now, does that mean go and buy it? No, because here's the problem you have, right? Is that means in 5 years' time, Netflix is going to double its EBITDA. That's tough to do in this sector. Movies flop all the time. Who knows what's going to happen there? Moreover, they are still losing market share. They're winning back some subscribers, but we don't know how their ads platform is going to do in terms of revenue. For me, saving a couple of dollars, watching an ad for 10 minutes, I'm saving a couple of dollars every day of the week. So I don't know how that's going to play out. For me, realistically, I'd probably be looking more at an EBITDA growth rate of 5% average over the next 5 years. A capital expenditures of probably 25, a DNA of 10, and I'd probably want a 20% discount rate. And the reason I'm doing it this aggressively is literally because I think that you can go and buy Apple right now in and it's Apple, it's not Netflix, and have a better chance of rate of return. If we put that in, it says that it is overvalued by 14%, but that means you're going to get a 20% return a year if it is priced correctly. So Netflix for me is just sort of in that gray area. And with the recent run as well, I think short term volatility dictates that when the market does pull back a little bit, Netflix is going to pull back a little bit too. And when that happens, that's when you look to allocate some shares, right? So you've got this big run up here in the market, and I think that if you get Netflix coming back down to the 250s, which I think will happen, by the way, then all of a sudden it might be a lot better opportunity. But right now, if you're going to buy a company, why would you look at Netflix when there's Apple there on cheaper valuations pretty much across the board, let alone the safety and moat of Apple? Because that's the biggest problem I have with Netflix is its company's moat. I don't think it's that big as it lets on. I think that Disney, HBO, these other companies, Prime, are going to come in and they're going to sweep up market share, and Netflix is going to struggle. I think Netflix really should be focusing on sports and getting live sports streamed on their platform rather than look at content because it's a lot cheaper to do and there's a lot more content there, a lot more watch time. That's my thoughts on Netflix. Let me know if I'm wrong down below.